The market doesn't know what keeps you up at night. It doesn't know when you want to retire, and it doesn't know how old you are. The simple truth is, the market doesn't care. But if you care, you've tuned into the right place. You're listening to Investor Resources, bringing clarity to the confusing world of finance. Here are your hosts of Investor Resources, Don Creech and Perry Sykes.
I'm Don Creech.
And I'm Perry Sykes, and welcome to the Investor Resources Podcast.
Remember who we are there, huh?
Yeah, what the heck?
Well, this week in the market has been one of optimism, and the inflation news wasn't all that bad, but Mr. Powell says rate hikes aren't coming, but neither are rate cuts. So It looks like the stock market bear market is officially over. I mean, there have been some doubters. In fact, as far as retail investors are concerned, there's still a lot of doubts. There are, let's just call them gurus in the social media world who sell a lot of fear. A lot of investors who don't study technicals or fundamentals either take that at face value. So that fear of the coming collapse of the dollar, of our economy, of a recession, and the next bear market are still out there in the investment world. But
Sure.
Where the bear of the market is in the realm of safety. Most advisors and most investors subscribe to some form of a 60% stock and 40% bond portfolio. The bonds are only there because that's their safety valve. You're afraid of risk, so the bonds are going to bail you out. That's the theory. That's the sales story anyway, because
That's
the
the sales
academic
pitch,
theory
yeah.
supporting that is pretty weak on the 60-40
Pretty weak, and
model.
it doesn't matter. You said 60-40, Don. It doesn't matter what the percentage is. They've got a fixed bond allocation, and it's like you said, that's the safe part of the portfolio. It's there for stability. It's there to counteract whatever's going on in the stock market. And what happens when that breaks down? If you are a subscriber to that strategy, if you're a pie chart investor and you decide that I'm going to have a permanent bond portfolio portion, then all you do is ignore it. It's like, well, my safety factor is not working. In fact, it's losing money again this year, and I'm just going to ignore it because I believe that that's the safe portion of my portfolio over the long run. But over even 3 years in a row now, bonds haven't been a great place to be.
Well, the problem here is that we've been in a falling inflationary environment, falling interest rate environment, falling inflation environment since the early 80s. So basically, we're looking at 4 decades of interest rates continuing to fall until
Sure.
fairly recently. I mean, the COVID, we had a bump up in rates after the mortgage debacle in the 07-08 era. And then they backed off with COVID to zero, essentially. And now we have inflation because of all the surplus cash that government and the Fed pumped into the economy to get us through their arbitrary lockdowns, where they basically said, we don't want anybody doing business when we don't want you leaving your home unless it's absolutely essential. And even then, we're doubtful that should happen.
Right.
So government created this inflationary cycle, and with that, interest rates rose. We've had this unusual change and relatively sharp change in interest rates since the post-COVID era has shown up. And we can see that in this chart. But here what we can see is that interest rates dropped precipitously with COVID, and they stayed flat trying to get us into some sort of recovery. And all of a sudden it's, whoops, we did way too much. Now we have to slow things down because inflation's getting out of control. It breached 9%, which we haven't seen in a long time.
You bet.
We have to go back to the 70s to get that. So now the question is, when are interest rates going to come down? At the beginning of the year, the bet was we'd see interest rates fall 6 times, quarter point at time, but there'd be 6 rate cuts this year, and the market celebrated that. Lower interest rates makes it easy to borrow money. Easy to borrow money makes it easy to expand your business, to hire people, to build new plants, buy new inventory. The easy days were back until they weren't, which is about now.
We were off to the races until we found out the race didn't actually start. So everybody's hold on here.
So this rate hike that shows up here on the screen is really quite rapid. This is an unusually fast rate hiking scenario for the Fed. It usually spreads this over a longer period of time, sometimes several years, maybe not always that long, but this was aggressive. And when interest rates rise, the value of bonds falls. It is an upside down relationship. Think of it as a teeter-totter. Rates are on one end, value of your bond is on the other end. As long as rates are rising, the value is going to fall. It's just math. It's the way bonds and interest payouts work. It's math. You think of it as when you were a kid on a teeter-totter, if you had a sibling, undoubtedly your sibling had you up in the air and jumped off the teeter-totter and you went crashing down. That's you hit the ground and you start crying and you get mad at your sibling and you start chasing around the yard. Well, that's kind of what happens with the value of bonds here when interest rates went up this high, is they just crashed. And we're now, as Perry, just as you said a moment ago, we're now in the third year of bonds continuing to lose value. And yet this is how most people are trying to protect themselves from stock market volatility, when in fact they are forcing themselves into bond market volatility. And this drawdown is actually more significant than people realize. It is the longest and most significant drawdown that we've had since, what's that chart say? It goes back to 1976.
Correct.
That's a long time, and investors have never seen this. Well, we haven't seen this. Might have been, we don't have data that goes back to the 20s. It might have had something back there, but if that was the case, somebody probably would have found it and generated a chart. But
you bet.
Here we are during the lifespan, the investing lifespan of the people who might be on this podcast and who are in the market today. This is an unusual event.
It is, and it's important to remember that with the pie chart investing, the people that can afford it the least, people that are retirees already in retirement, those are the people that are getting the largest allocation of bonds because it's age-based. So the older you get, they keep increasing your quote safety, and they keep increasing your bond percentage holdings. The older you get, because they're just basing it on your age instead of what's going on in the market. And as the bond market continues to deteriorate, your percentage of the bond market in your portfolio keeps increasing, because that's the way that whole process works. And so it's the opposite of what you need right now, and they don't make adjustments for what's going on currently. It's just those long-term historical averages, and then you just have to live with it. So the older you are, their process they think is going to increase your safety. Right now, it's the opposite is happening. You're getting more volatility and losing principal at this point.
The problem was actually amplified during the zero interest rate period, because people who felt they really needed bonds for income extended the maturity date, called the duration. Sure. They would go out to a longer time frame in order to get a higher rate of interest. And that's really increasing their risk profile. Most of them didn't know that that's what they were doing. These in many cases were treasury bonds. Well, those are safe, aren't they? And the government's going to pay. Yes, they are. Right. If you live to maturity. So if you're out with a 20 or 30-year bond, you get your guaranteed principal 20 and 30 years from now. Most people in retirement aren't assuming that they're going to wait that long before they need the money.
Sure.
if you're a Bill
And
Gates,
that big change in rates, it doesn't matter how much money you have. If you go back and look just recently at Silicon Valley Bank, they went under because they got long in treasuries. It was going to be a nice, safe ride, to place nice, safe place to hold all of their clients' cash. And then the interest rates changed so rapidly that they couldn't keep up and they couldn't sell them because the interest rates were too low. So it doesn't matter if you have billions of dollars in your care. If that interest rate moves against you rapidly, bonds are a terrible place to be. It really does cause a problem. Bank collapse because of it.
well, Silicon Valley wasn't the only one. We had three banks back in
Yeah.
March that
Yep.
all went under. It was all the same thing. They were looking for a higher rate of interest for the cash that they were holding for customers. And in order to get that, they went out 20 years or longer. And then when the rate increase that we just had on the screen a minute ago, this increase right here, this on a teeter-totter caused value of their bond portfolio, their high quality treasury bond portfolio collapsed. And then the run on the bank came. I want my cash. How do I get the cash? Well, they have to sell the bonds. So they can't sell the bonds. So the Federal Reserve basically took over the three major banks that had that problem. There's been another one since then, Community Bank of New York, a similar problem. This actually works out in individual client portfolios. And if you think it's not a big deal because it's just, it's treasuries and these things will get resolved, you have to understand what I said earlier about duration is really important. What this chart shows us is that the longer you are invested here, this is the 30-year bond since interest rates started rising, is down 58%. That's your safety valve. Well, not everybody puts all their money in 30-year bonds, but the 20 years off 43, and this is the 7 to 10 year treasury. This is an exchange traded fund, but trades at IEF, and then the shorter term one is only down 10%. And you say, well, it's a bond portfolio. I wasn't expecting these kinds of losses with my safety valve. So
Correct.
it's something that's really important to pay attention to, and it's the reason that we do not use modern portfolio theory and force people into bonds when bonds are losing money. Part of our investment policy is if it's not making you money, why is it in your portfolio? Let's find something that's working, put that in, and hold it while it works. When it quits working, that's the time to rotate out, decide to do something that's actually beneficial for your portfolio. Now, that means somebody has to pay attention to this. Who's going to watch it? I mean, you can. What we're talking about is not rocket science, but it does require some inexpensive software to track what you own and a process of review and decision making, and then following through periodically to see if you're still on track. On track doesn't mean you're on track for 20 years from now. On track means in this marketplace, are you on the right side of the track? You're on the train that's going forward, or are you on a train that's in reverse? Well, somebody's
You
got to
have to
watch
be
that.
willing. You have to be willing to make a change, and that's one of the people get too comfortable with. Well, I'm just going to sit where I am, and my broker told me eventually this will all just work out. And like you said earlier, Don, if you've got 20 years, 30 years, it probably will. Most of us don't have that kind of time to sit around and watch. So you have to be willing to make the change when it's necessary, and that takes the discipline to be monitoring what's in there and willing to make a change when it's necessary. As far as what's going on in the market, not as far as what has gone on in the market for the past 50 years that is of no value to you at this point.
Well, if you have concerns about your portfolio because you have a fairly significant portion in bonds, you might want to talk to us. You can give us a call, send us an email. We'll be glad to chat with you. Sign up for our podcast so you keep current with what we're covering, and register for our webinar. Links are in the final slide here. Have a great day. We'll be back with more exciting information. At least that's our assumption.